1. Distinguish among depreciation, depletion, and amortization. Depreciation, allocation of the cost of tangible fixed assets over their useful lives, for example, buildings, machinery. Depletion, allocation of the cost of natural resources as they are consumed, for example, all minerals. Amortization, allocation of the cost of intangible assets over their useful lives, for example, patents, copyrights. 2. Factors in determining annual depreciation charge, useful life estimate of how long the asset will generate benefits, residual value, expected value at the end of its useful life, depreciation method, straight line, declining balance, etc. These involve judgment, not purely objective determination. 3. Does accounting depreciation measure value decline? No, depreciation allocates an asset's cost over its useful life, rather than reflecting actual market value changes. For 3 main characteristics of intangible assets: lack of physical substance, identifiability, can be sold or separated, provide future economic benefits. 5. Cost of intangibles acquired for shares. The cost is measured using the fair value of the shares, exchange, or the intangible asset, depending on which is more reliably determinable. 6. Amortizing limited and indefinite life intangibles. Limited useful life, amortized systematically over its useful life. Indefinite useful life, not amortized but tested for impairment annually. 7. Factors to consider in estimating the useful life of an intangible asset. Legal or contractual limits, expected usage of the asset, technological obsolescence or industry trends. 8. Distinction between current and non-current liabilities. Current liabilities, obligations due within 1 year or the operating cycle, for example, accounts payable. Non-current liabilities, obligations due after 1 year, for example, bonds payable. 9. Relation between current liabilities and operating cycle. Current liabilities are tied to the operating cycle as they represent obligations that need to be settled within that cycle. 10. Present value and liabilities. Liabilities are reported at the present value of the expected future cash outflows. 11. Accounting for zero interest-bearing notes payable, recorded at their present value by discounting the future payment. The difference between the present value and the face value is recognized as interest expense over time. 12. Sources of long-term debt for corporations. Issuance of bonds, bank loans, lease obligations, convertible securities. 13. What is a bond indenture? A legal contract between the issuer and bondholders detailing the bond's terms, such as interest rate, payment schedule, and covenants. 14. Effective bond premium or discount on interest expense. Premium reduces interest expense over the bond's life. Discount increases interest expense over the bond's life. 15. Distinction between common and preferred stocks. Common stock, voting rights and variable dividends. Preferred stock, fixed dividends, no voting rights, and higher claim on assets than common stock. 16. Preference shares in financial statements, reported as part of equity, often in a separate line from common stock. 17. 5 elements included in equity: common stock, preferred stock, retained earnings, additional paid in capital, treasury stock. 18. Major characteristics of plant assets. Tangible, used in business operations, provide benefits over multiple accounting periods. 19. Items included in acquisition cost of plant assets: land, purchase price, legal fees, clearing costs, machinery and equipment, purchase price, shipping, installation, testing costs, buildings, purchase price, renovation, permits, architectural fees. 20. Difference between acid test ratio and current ratio. Acid test ratio measures liquidity excluding inventory. Current ratio includes all current assets. Both assess short-term financial health